Today's presentation is about crushing the market with options. This is how we trade options here at Trading Wins. For those of you joining us the first time or seeing us present for the first time, a bit about us here at Trading Wins. We are a group of pro traders with well over 30 years of experience. We are real traders and teachers, and we've been developing our own strategies and systems over the years and teaching people from complete beginners to experts around the globe. Now, in today's presentation, I'm going to briefly go over, some of the option basics, and then I'm going to tell you why you should and how to trade calls and puts. I'm going to tell you how to trade during periods of high volatility, and this is really all about the right way to trade an earnings report. I'm going to show you how you can protect your positions with options and explain who actually really makes money in the options market, and then tell you how you can as well. Okay? Time permitting, we'll get to as many of your questions as we can. Please remember, options or trading in general can be extremely risky if you don't know what you're doing. So please educate yourself first before trading with real money. A few poll questions before we get into this. Out of curiosity, how many of you have seen me present at an event or webinar such as this before? Please take a moment to type in a yes or a no. Thanks. Great, thank you. Perfect. Just a couple more quick poll questions here, and then we'll get right into this. We have a lot of material to cover. Out of curiosity, how many of you have actually traded options before? Yes or no? Okay, we have a lot of first-timers. That's good. Excellent. No worries. I'll try to cover this in as much detail as I can with the limited time we have available today. And lastly, if you have, on average, how many option trades do you place per month? Is it 1 to 10, 11 to 20, or are you very active? I see Jim is saying options are too complicated. Well, Jim, that's what I'm going to try to show you today, is that they actually can be quite simple to trade. I'll do my best to explain exactly how you can do that today, while we have some very active traders here as well. Okay, great. Let's move on. So when it comes to options, there are a lot of myths out there. Let me break these down for you. The first myth is that it can be very complicated, as Jim just said. Well, the truth is that it can actually be very simple to trade. Another myth is that they're extremely risky. But in reality, once you know how to trade them, they are actually very, very safe. They can actually be a lot safer than trading stock. So the key to success is actually knowing when and how to trade these, and that's what I'm going to show you today. Now, when it comes to what a call is, what a put is, etc., we have a very limited amount of time together today. So I'm just going to put these on the screen here. When you receive the recording, you can pause it and read through this. All this information is available for free online. So I'm just going to bypass this quickly and get into the meat of this presentation. So a few terms you should know is, number one, option premium. Now, an option contract, one contract, is the equivalent of 100 shares of underlying stock. So for example, if you're buying one call option at $1.50, you have to multiply that by 100. So your cost would actually be $150. Okay? So now, what type of options are there out there? What can you buy them on? There are thousands of stocks that are optionable, approximately 4,300 in the US. And nowadays, there are actually hundreds of stocks with weekly expirations, which has become much more popular recently, and I'll touch on that a little more later. You can buy options on indices such as the S&P, the Dow Jones, the Russell, etc. You can also buy them on futures, crude oil, gold, wheat, coffee, all of that. In other words, just about anything out there. Your choices are very broad. few terms you should be familiar with. In the money, or ITM option, this is when a call option has a strike that is below the current market price of the underlying, or the put has a strike that's above the current market price. Out of the money, OTM, is when the call has a strike price that is actually higher than the market price of the underlying, or the reverse, the put has a strike that is lower than the market price. And the at the money is the strike price that is closest to the current market price of that underlying. Intrinsic value. This is the in the money portion of an options premium. Each option premium is made up of an in the money and out of the money portion, so intrinsic value and extrinsic value, which is the time values. So the extrinsic value is the portion of that option premium that is out of the money. That's the time value. Okay? And more importantly, implied volatility. This is the estimated volatility of a security's price. Okay, now the volatility will increase more when the market is bearish than when it is bullish. This is because when the market drops, people tend to panic. So the pullback in a market tends to happen a lot faster than the rise. And that's why volatility increases much more during a downtrend than it does during an uptrend. Option facts, they're only risky if you don't know how to trade them. I'm going to show you exactly how you can trade them very safely. Okay? Over 80% of all option contracts expire worthless. This is a fact. Okay? And unfortunately, most people only buy options. They don't sell them. And not only that, but they do so without taking fair value and implied volatility into consideration. So in other words, what ends up happening is they buy overpriced options and end up losing money, even though the underlying stock has actually moved in their favor. Okay? So when it comes to buying options, there are only 5 scenarios that can possibly happen. The option can move in your favor by a lot. It can move in your favor slightly. It can be flat, okay? Or it can move against you slightly, or it can move against you by a lot. Now, when you're buying options, if the underlying stock moves in your favor by a huge amount, you're going to make money on that option. If it moves slightly in your favor, you will only make money if you had looked at the implied volatility and the option's value. In other words, if you bought a fairly valued priced option, you will make money. If you bought an overpriced option, you will actually lose money. Now, if the underlying stock goes flat, you're going to lose money because of that time value erosion. If it goes against you slightly, you're going to lose money. And if it goes against you by a lot, you will definitely lose money. So, in other words, when it comes to buying options, at best, you have a 2 out of 5 chance of making money. And in most cases, for most people, it's 1 out of 5. Now, when you're selling options, the same 5 scenarios can happen. The stock can move in your favor, slightly in your favor, go flat, slightly against you, or greatly against you. The difference is that when you're selling options, if it moves in your favor by a lot, you're going to make money. If it moves in your favor slightly, you're going to make money. If it goes flat, you're going to make money. Even if it goes against you slightly, you will still make money. The only time you will lose money is if it goes against you by a lot. So in other words, the risk reward is completely flipped around. And now when you're selling options, you have a 4 out of 5 chance of making money. Remember, over 80% of option contracts expire worthless. That's why this scenario exists. So now when it comes to time decay, what you need to know is that when you're buying options, you want as much time in your favor as possible. This line here is what you should be paying attention to. This is the time erosion. And the closer you get to that expiration, the quicker that erosion accelerates. you'll notice here that within the last 30 days to expiration, that's when the bulk of the erosion happens. So if you're long an option, if you're buying options, you want to be out of that option before you have less than 30 days to expiration. Okay, by the 30-day mark, you want to get out of that. And you also want to give yourself plenty of time, generally at least 90 days, okay, to expiration. But we'll talk a bit more about that in a little while. If you're selling the option, it's actually the opposite. You want to sell in here because you want that option to expire worthless. You want that time erosion to happen. It'll be in your favor. So you want to sell maximum 40 days out, preferably 30 days or less, to take advantage of this drop. Okay? So there are dozens of option strategies out there. I'm going to cover a few for you here during the next 40 minutes or so. But the key is to understand when and how to use each strategy. Okay? And remember, you don't need to know them all or use them all. What you need to do is only trade the ones that make you money. Okay? So let's go through a few of these. So strategy number one. How can you buy Starbucks for $1? For less than actually a cup of coffee. Let me bring up my charting platform and show you. So in other words, if you were going to purchase Starbucks and you're going to buy 100 shares of the stock, well, stock is $54.62. That's going to cost you $5,400 roughly. But how can we buy this for $1? Well, let's look at the options. So, excuse me, we can go out here and buy a straight call. Here, the Octobers, that gives us 111 days to expiration. Remember, you want at least 90 days, okay? Preferably more when you're buying an option. And we can go out to the 57.5 strike and purchase that call option for just a little over $1. Okay? Now, the problem with this is, remember, if we've priced it correctly, we have about a 2 out of 5 chance of making money. Okay, so how can we give ourselves a little more flexibility with this? Well, there's many ways, and I'll go through a few. But if you have the capital to buy the stock, okay, you compare it with a put for protection and for flexibility. Let me explain. If you were to buy Starbucks for 54.5, let's say, and you go out and you purchase the 57.5 strike put, which is an in-the-money put, for about $4. Okay, let's look at the cost basis. You're buying it for 54.5, and you're also spending $4 on the put. That's 58.5 that you're spending. But what this gives you, what this put gives you, is the right to sell this stock, sell your shares, anytime between now and expiration for 57.5. So no matter what happens with the stock, you know, there could be a news announcement overnight and Starbucks opens up at $20 a share, let's say, okay? It doesn't matter. You have that right to sell your shares at 57.5. All you have to do is exercise your put. So your cost was 58.5, but you have a right to sell it at 57.5. Therefore, your total risk, no matter what happens, is $1. Okay? Now, the flexibility comes in as the position moves. So if Starbucks starts trading higher, you then can move your put up and to lock in profits. Okay? You can then write a call against it to collect more premium and increase your profitability on the trade. There are many things you can do. That's the advantage of pairing the stock with the put. But if you can't afford the capital on the stock, well, you can simply buy the call option for roughly the same amount. And here, you can look at this, but what you'll find is that whenever you want to pair a put with the call, if you don't want to do the math in your head, just look at the call option column here at the same strike, and this amount will be approximately what your risk will be should you buy the put with the stock. Okay? So you see here at $60, we'd be spending roughly $6. So if we paid 54.5 plus 6, right? That'd be roughly 60.5. But we have the right to sell it at 60. So our exposure is about 50 cents. If we look over here, the calls 52 to 57. Okay? It's not going to be perfect, not to the penny, but it'll be approximate. Okay? A very quick and easy way to spot what your risk would be should you buy that. So now if you're buying the 57.5s, for example, that's a 69 delta or a 70 delta. Delta is the amount that your option price will move for every dollar move in the underlying stock. So if Starbucks moved up $1 and you had a put with a 70 delta, you'd lose 70 cents on that put. Okay? But remember, you're making $1 on the stock. So your net credit is 30 cents. You're still making that profit, excuse me, of 30 cents with that move, okay, etc. And so we'll get into this a little more as we go through this. But that is one way to use options where it makes it so much safer. If you were to just buy the stock, you'd be spending $5,400. But if you got a gap against you or a quick move against you, you'd experience a significant loss. By doing it this way, your absolute worst case scenario is that $1 of risk. Even if you're buying the call outright and not buying the stock, the amount you spend on that option is your maximum risk. Okay, there's no way you can lose any more than that. Okay? Let's move on and let's look at our next strategy here. Okay? Earnings. How do we take advantage of earnings? Many people love to play earnings, okay? But they do it the wrong way. Let me show you the right way to play earnings. And I'm going to switch over to Apple. Now, most people play earnings trying to guess the direction of the gap on earnings. So the day of or the day before earnings, you know, they jump in and they buy some calls or they buy some puts, hoping for the gap in their favor. Well, the problem is that they're going to lose money doing that, even when they are right. And let me explain why. If you go to the option chain and you collapse all the expiration dates, and you look over to your right, at least in Thinkorswim this is the case, and you see these percentages here, that's the implied volatility. Okay? Now, generally, when you look through these, what you will see is they will mostly be all in the same range. You see here on Apple, they're all pretty much in the mid-20s. So that's an average price. So when you see one, like we do here, that's at 93, that's way overpriced. Okay? That's a quick way to look at that. But what you'll find with earnings, okay, is that as you head into the earnings announcement, the implied volatility goes sky high. Okay, in other words, from the mid-20s, it will go to 100, 120, 150. It depends on what the expectations are for that report. But let's say it goes from 25 to 100%. Now, once that earnings announcement is released, this will immediately go back to the 25%. It will go back in line with the average. So in other words, what that means by that going from 100 back to 25 is that you will lose 75% of the value of that option contract immediately. So even if the stock gaps in your favor, you think, wow, it gapped in my favor. I bought the option at $10. the stock gapped up $10, I should be making all sorts of money. Well, in reality, you just lost 75% of that. Your option contract is now worth $250 before you incorporate any sort of gain. Okay, and that's the problem that most people face. It's called a volatility crush. So the right way to trade earnings is actually the run-up into earnings. So if you look at Apple before every earnings announcement, it's actually kind of flat. It really doesn't have much of a run-up. But when you look at a stock like, for example, let's see if CMG does. Okay, seen to earn just before this earnings announcement here, there was a run-up. Just before this one, there was a run-up. Okay, in this case it was down. In this case it was up. So 3 out of the 4 were to the upside. Okay, so now what we can do is about 2 to 3 weeks before the next earnings announcement, okay, we can check the chart and see if there is any sort of signal or technical reason for us to get in to the long side. And what we want to do is be in there for those 2 or 3 weeks, not only while, you know, with the anticipation that the stock is going to appreciate and make us money by moving in our favor, but the volatility will increase on its own just in anticipation of that earnings. Okay, it will go from that 25 area up to 100 or more, and so you'll get that 75% of that volatility increase in your favor as opposed to against you after the earnings report. So the right way to play earnings is to take advantage of that volatility increase 2 or 3 weeks before earnings and be out of that position the day before earnings. Okay? That's really the right way to play earnings. Okay? Let's look at something else here. Let me just bring up another slide. Oops. Here we go. So, how do you protect your position or your entire portfolio and lock in profits with options? And we talked a bit about that already with the Starbucks example. Okay? So, now with Starbucks, here, let's say we had bought in this area here and it made a really nice run. Okay? So now we know that once we were here, we could have bought the call on its own. We could have bought the stock with the put and protect ourselves. Many ways in it. How do we take advantage of this even further? How do we increase our profits on this trade without increasing our level of risk? Okay? So let's say it had moved from this area when we bought it in the 50 range up to 54. Okay? So let's look at this now. Let's say we bought this now. I mean, these figures would be different, but it's pretty much the same thing if you look at this. If you had bought this and your total exposure was for $1 here, and then it had moved up $4 or $5, of course you're going to lose premium on your option, okay? But you're gaining even more on the stock. Okay? So how do you roll this up and lock in profits while still keeping your position protected? Okay? If you were to sell this option, okay, let's say this option now, excuse me, let's say it was cut down to $2, all right? Well, you sell that and you take those $2 and you move it up and you're buying a higher strike. So you're going to pay more for it, okay? If this went down, this would go down as well. Let's say this was worth $5, okay? You'd be moving it up and spending a little more, but you'd be locking in profits. Your strike price would be going higher. Okay? The right you have to sell it at, the price you can sell it at, is much higher at the same time. So what you're doing is you may be spending a little more, but you're locking in profits. Okay? And that's the key here. And at the same time, think of it this way. What happens to call options when the price moves up? Right? They gain in value. So now when they do that, you write a call against, you sell a call against it, and you collect that premium. So that's the real advantage here. If you had bought this 57.5 put and the stock went up $5, these calls here would be worth $4 or $5. Now you sell those against it and you collect that. If it continues going up, you get exercised, you have to hand over the stock, but at a very nice profit. If the stock moves back down, that call expires worthless, you keep that money, and your cost basis has been reduced even further. But remember, the nice thing about that is that you always have that put, and you always have that right to sell it at that price. So even though the stock goes down, you collect money on the call, but your position is fully protected at all times. Okay? Let me show you one last thing here. So how do you create a steady income with options every month? How can you do that? Well, remember when I showed the diagrams on your likelihood of making money when you're buying options versus your likelihood of making money when you're selling options. Clearly, the money's in selling options. And this can come in the form of credit spreads. Okay? So in other words, let's look at a stock like KR here. So right now, here it is at this point. It's kind of flat, right? It can go either way. But let's say we have a technical signal telling us to get in long here for another move. Well, we can buy the stock with a put, we can buy a call, or we can sell what's called as a put credit spread. Okay? What we'd be doing here is selling a put and buying a lower put for protection. Let's go to the chain here on Kruger. Now, if we're doing that, remember, we're not doing it with 111 days to expiration. We want the shortest amount of time possible. Okay? Now, I don't know if there's going to be enough premium on Kruger here with 20 days, but let's have a look. If we sold the 72s, we'd collect 80 cents. We'd buy the 70s at 35 cents for protection. Okay? So we would make here 45-cent profit as long as Kruger remained above 72.5 at expiration. Okay? So the key, though, with credit spreads, what you want to look for when you're collecting premium is you want to collect about 20% of the difference between the strike prices. Okay? So if you were doing a 10-point wide spread, if I was selling, say, the 80s and buying the 70s, giving myself $10 of room there, 20% of that is about $2, right? So if it's $5, I'm looking to collect $1, and so on. You want to collect about 20% of the difference between the strikes. The other rule of thumb is that when it moves in your favor, regardless of the amount of time you have left to expiration, once you're at about 80% of your profit that has been realized, you want to close out that trade. You don't want to take the risk with the remaining days to expiration, just for that last 20%, that the position moves against you. Okay? You want to take that profit. But the real key to credit spreads is where you place them. Okay? So for example, what I like to do is I like to have levels of protection in front of me. I look at levels of support and resistance. So for example, this would be one of them here. I'd look at this level here, this previous low, as a level. I'd look at this level, etc. Wherever your levels are. Now, of course, you want to trade a stock that has enough premium for you to collect. But think of it this way. If you're going to place a long position here, I want to sell my put credit spread somewhere down here. Why? Because whenever a stock pulls back to an area of support or resistance, okay, it usually, excuse me, at least stalls or bounces. It can break through, but there's usually, with that level of protection, you always have that probability that it's going to bounce off that level. And if you have multiple levels of protection in front of you, this is the key, because Remember, if the position moves in your favor a great deal, you're going to make money. A little bit, you're going to make money. If the stock moves flat, you're going to make money. And if it moves against you a little bit, meaning it does not go below your short strike, you're still going to make money. Even if it comes all the way back here, okay, on expiration, you still will realize the full amount of profit. Okay? The only way you lose money on these trades is if the stock trades below your short strike, below this level. Okay? So how do you not get caught with that? Well, what you want to do when you enter that trade is always measure the distance from your entry, from the current price, where the underline is on entry, to your short strike. And if you get a move against you, what you want to do is break this up into quarters, okay? And should your stock pull back to about the 3/4 mark, you want to, at that point, decide whether you are going to roll down your position, or just close out your position, okay? You do not want to get caught with it going beyond your short strike, all right? Okay, I know we have a lot of questions here. Do we have time to answer a few of them? Okay, I'm going to bring Raul in, our coaching coordinator, in to help me read off some questions, and we'll try to get through as many as we can with the time we have left.
That's a lot of information to pack in.
It is, unfortunately. Options, you know, there's a lot involved.
Question from Mike. First of all, do you let the spreads expire or close it before expiry?
Well, the spreads, I mean, if they're, you know, if this has moved hugely in your favor and the stock is now up here and your spread is down here, you would just let it expire. Because if you're going to close it out, you're going to have to pay more commissions. So you just let it expire. But if there's any chance of this coming back, having enough time left to expiration to come back and hurt you, then you would close it out.
Laura says, Vince, really impressed with the credit spread section that you just taught. What type of portfolio size do I need to trade this system?
You really don't need a lot. When it comes to options, you know, you can do one contract, and these positions are protected. You're not selling naked options here. You're protected. So your total exposure here is the difference between what you collect in premium and the difference in strike price. So it can be a matter of a few $100s. It's not a lot.
Andrew's asking, what does Vince think of trading weekly options?
They're fantastic, actually, especially with the higher priced stocks over $100. Weekly options are great.
That's actually my next question from Lazard. I hope I'm saying that correctly. He's asking, does Vince generally trade higher priced options, or does he also look at lower priced options, for example, $20 or less?
Underlying stocks?
Underlying stocks, I'm sorry.
Yeah, I generally don't. I mean, I will trade straight calls sometimes on low price stocks. I've even traded them on like $6 stocks at times if I see a very strong technical pattern. But generally, I like to look at stocks that are $50 and higher for options.
You've been in the options game for quite a while.
Yeah.
What's changed over the last 15 or 20 years, other than the fact that you can get quotes, you know, as you're walking to the coffee shop?
That's right. Well, the weeklies have made a big impact, big difference. And the main thing is, with all the information, like you're saying out there, now with the different platforms available, anyone can get information. So there's a lot more people trading options these days. So
commissions on these now, on these options,
are very inexpensive.
Now, back in the day, if you wanted to put on a butterfly or a condor or one of these exotic kind of positions, it would cost you hundreds of dollars, and that would wipe out what your profit would be.
That's right. Nowadays, it's insignificant. Yeah.
Is it realistic for a small investor to think that they can create a decent living with these options?
The key is understanding how to use them and how to execute it so you're always protected. That's the key, because once you have that position put on correctly, you're protected. That's why I say they're a lot safer than trading stock. Look at these moves. You never know when these moves can happen against you. Well, if you have, you know, just a straight call up here, it's impossible to lose any more than what you spent on the call. Or if you have that put, you always have that right to exercise it no matter how low the stock goes. And the number one enemy for traders is always the gap. Okay, there's no way no way to avoid that gap or not get hurt by that gap unless you have the proper options position put on.
Vince, we've got about 9 minutes left. I see Andrew, Aaron, Jonathan, David, Lena, and Fernando. They all have questions. I will do my best to get to as many of those as I can, but I know you need to get back to your presentation and wrap it up.
Let me just recap the advantages of trading options, okay? It's the cost efficiency, like I said. You can trade it with a very small account, but you can also leverage it with a large account. Because buying multiple contracts or a larger size of contracts is still going to cost you a lot less than buying those shares outright, and it's still going to be a lot less risky. Okay? It's going to be a lot safer, so you can really leverage this. And this is the main point, less risk. That's what you want, less risk, okay, if you do this correctly. Your higher potential returns. Again, if you have multiple contracts, you can really leverage this. And one of the best things, okay, which I haven't had time to cover here, is greater flexibility. Okay? We always like to say that with options, you have options. That's the key here. There's so much you can do with options. Okay? Now, I know there's a ton of questions still. I'll try to get to as many as we can, but before we get to that, let me tell you about a pro class that we have on this coming up Friday, July 17th, 1 o'clock, slated for 2 hours. I'm going to be teaching the class. It will be recorded if that date doesn't work for you. But during this class, I am going to show you in detail how we create a steady weekly income using those credit spreads. We're going to spend a lot more time on it. I'm going to show you the ins and outs, how to do this. It's normally a separate course that we sell for $147. I'm also going to show you butterfly spreads. And for those of you who haven't traded butterfly spreads, they're really exciting because you can risk a very, very small amount. It's usually a 1 to 10 ratio. You're risking 1 to make about 10. Okay? So I'll show you how you can risk about $90 to make $1,000 on that trade. And 90 is all your risk. You can never lose any more than that. I'm also going to teach you delta neutral strategies to make money even when stocks are flat. So in other words, if you have a position, like we looked at KR recently where it was flat, you don't know what the next move is going to be, long or short, you can put on these delta neutral strategies and still pull some money out of the markets. And a real key is knowing how to repair option trades when they go bad. I'm going to cover that in detail as well in the course, okay? And together, we're going to look for trades setting up so we can all walk away from that class with some trades to put on that coming week. The link for this class is tradingwins.com/crush. But before you place that order, let me tell you exactly what you're going to get so you know that it's right for you. As soon as you do place the order, about half hour or so afterwards, once the order is fully processed, you're going to receive an email with a link to an on-demand recording of the previous pro class we did. Okay, so you won't even have to wait till the 17th of July. But regardless, we'll still have a seat reserved for you at the class on the 17th. And we are also going to throw in a 30-day membership to our pro service. Let me tell you a bit about that because it's really one of the best parts of this package. Our pro service is the most powerful way to get access to all our systems. We have, like I said, our own strategies and systems that we've developed. Some we haven't even released to the public yet. I'm sure many of you have seen them on previous presentations as well, but you get access to all of those. You get real-time trade alerts showing entry, stops, and profits of the trades we actually take. Every night from Sunday to Thursday each week, we send out premium nightly videos that will teach you how to trade our various systems. You'll have access to that, and you have access to our members-only weekly chat, where you'll get direct access to me. In other words, every Thursday morning from 10 to 11 a.m., you can come into our room, ask me any trading-related question you like. Those are also recorded, and you'll receive those recordings as well. Again, those happen every week. And you'll get access to our library of past educational sessions. Okay, together this package is $982, but we're not going to ask you to pay anywhere near that. In fact, we're pretty much giving this away. We want you to see what we're all about here at Trading Winds, and hope you join our family here. So for today, all we're asking for is $47 for this class. There's a ton of material there. The link is tradingwinds.com/crush. Okay. The link will be put in the chat for you, so you can just click the link from there. Again, let me recap. I'm going to show you in the class how you can earn a steady weekly income. We're going to cover the weekly options as well as the monthly options using those credit spreads. I'm going to teach you the right way to put on those butterfly spreads, as well as the delta neutral strategies to take advantage of those flat periods. We will cover the earnings trades in detail, and more importantly, I'll show you how to repair trades that have gone bad, both stock trades as well as option trades, and together we're going to search for trades coming up for that coming week. And remember, you're going to get a 30-day membership to our pro service, all of that for just $47. Again, it's tradingwinds.com/crush.
There are a lot of questions. I'm going to get to those now. Just on that point with the butterflies to make $1,000 using Night, we actually had a trade similar to that on Apple not too long ago.
Right. Our best one actually was on Netflix. It was huge. The return was huge on that.
Question from, Sil. On your protective put strategy, how far out do you go in time for ultimate benefit if you do at the money put or out of the money puts?
It depends on what kind of move you're actually expecting in the stock, how strongly you feel the stock is, because you can go, as I said, 2-3 months, or you can do this with leaps too. Leaps are long-term options, like for next January, the following January, and then the nice thing about the leaps is you're protected. You always have the right to sell that stock at that price up until expiration. So if you buy, say, a 2017, a January 2017 put, you have from now until January of 2017 to exercise that option at that strike price. So whether you go at the money or further in the money or out of the money, it all depends on how much risk you're willing to take. I'll cover all of that in detail. We're going to go through several examples throughout the course.
Antonio says, hey Vince, great to see you again. I'm joining you for the 1 o'clock session today.
Oh, great. Yes, that's right. We're teaching this pro class today. Unfortunately, it's sold out for today.
It's sold out for today.
Yeah.
So that's why we're doing the second session on
right.
the 17th of July. And I expect that to be sold out as well. That's a lot of content and information. 3 hours worth of content
Absolutely.
and information for $47.
Right.
You're going to get to learn everything. I love, the delta neutral strategies are probably my favorite things because a lot of people are worried about market direction these days, and the delta neutral strategies sort of give you that protection either way.
That's right. That's right. And we'll show you from a technical perspective exactly how to find those opportunities and how to take advantage of them.
Tony's asking, are these strategies suitable for IRAs?
Yeah, actually, they're very safe. That's the best part of this is the risk-averse nature of these strategies. Locking in a very, very small amount of risk. That's the key here.
The scan that you'll be doing on the Pro class, will that take advantage of all of your systems that you have, or
right?
Just one particular
As we go through each strategy and so on, we'll be looking for opportunities currently happening in the markets, and whatever trades we come across, we will look to take advantage of those.
We've got about 2 minutes left. I want to say thank you to Stanley, Mavis, Wynn, Ivan, Gary, Isaac, Robert, Gary again, another Gary, Steve, Julius, Gerard, Anthony, Kathleen, all for signing up for the class, which is coming up quicker than the last one. Thanks so much for doing that, folks. Kathleen actually had a question. Vince, I understand the offer is $47, includes a month of service. What happens at the end of that month?
If you're enjoying our service, you don't need to do anything. It will automatically renew at $97. But if for whatever reason you'd rather not continue, just give us a call and we'll put a stop to it. We call it the world's easiest cancellation policy.
Kathleen's asking, I'm around later today. Is there any way that I can join the class at 1 o'clock?
Unfortunately not. The key to this class is for us to answer all your questions so that when you leave the class, you can completely do this on your own. And so for that reason, we do have to limit the class, and this one has been completely sold out for a while.
New purchasers that have just come in: Scott, Myron, Calvin, Andrew, Mark, Chris K, and Jerry C. Thank you so much for joining us today. What's the best part about the pro class, other than the fact that it's 3 hours of you talking?
You know what? There's so much material. This is a way, even for those of you who are just starting out with options, this is a quick and easy way to really increase your knowledge when it comes to options and take your trading to the next level, because I will cut out all the theory and all the fluff and just stick to exactly what you need to know to protect yourself.